Hey everybody, it's Sarah Porras. How are you? It is the Monday Mortgage Minute. I am back. Haven't done one of these in a while. Actually, today's is going to be 10 or 15 minutes, so get comfortable. This is going to be extremely interesting. This is my friend Matt Listro. He used to be from Connecticut. He is now relocated down south, but what does that matter anymore? Everything's virtual, everything's over Zoom. And he has a company he's going to tell you about in a sec, and he did a webinar the other night about trends in credit scores since the beginning of the pandemic. So comparing just before the pandemic hit and what's going on now. I was enthralled. His presentation was like 50 minutes. I said, hey, I got to get on a Zoom with you. Let's do like 3 or 4 slides. And let's just talk about the stuff that I get questions about all the time, which is credit scores, credit reports, how to improve your credit, what goes into a credit score. So Matt, let us know a little bit about yourself.
So I've been in the credit game for a long time. I've been repairing people's credit now. I started in 1995. I had some friends of my parents who wanted to buy a home and they couldn't. And I'd heard in 1995 that you could write a letter and fix that. So I did, and it worked. And in 1996, I started charging a fee for that. So I've been in the credit industry trying to help people with their credit for 25 some years. It's been a long time, 25 plus. And that's it.
Great. You have a company called Credit Admiral, and I'm not sure exactly what
I have a few. I do my retail company where we help retail consumers as national credit fixers, a software company, Credit Admiral Software, where I rent software to credit repair companies across the country. I also do a convention for credit repair companies. It's the largest domestic credit convention in the country dealing with credit scores. So I do a few different things along the credit lines.
Great, cool. So let's start with this one graph you showed the other day, and it's a trend. Oh, you have to share your screen. You can do that, right?
Yes.
We were talking earlier before I started the recording. This is what credit scores, how they've risen since 2005 to July 2021. It looks like an upward trend. Let's talk about why.
Yeah, generally we've been in an upward trend for credit scores. There've been some things that haven't. You can see in the early end of this graph, the mortgage meltdown from 07 into 08, you see the scores go down a little bit. And there have been some things that artificially have increased scores. In 2017 and into 2018, there was the removal of all public records. Well, not all public records, all judgments and tax liens from credit reports. And that caused an arbitrary increase in the scores. And so in that region over here, you can see there was probably a little bit more increase than there should have been with those things coming off credit reports. But even now, you see the sharper increase in the score since the pandemic has began. That's what most people find interesting. The credit scores have been doing very well since the pandemic. In fact, this chart stops in July of 2021, but the new one for including October of 2021 is exactly the 3rd month in a row, a 716 average national FICO score. So we're maintaining that average score of 716 right now.
I think one of the takeaways of this is that lenders, creditors during the pandemic, since the pandemic, have not hurt you. Okay, so they haven't, your score shouldn't have gone down because of a COVID hardship. Right? So if you've had a COVID hardship and you have not reached out to your creditors, it's probably not too late to go, hey, the reason I've been late all this time was because, and if you submit documentation, they may go back and correct. I can't guarantee that, but it's something you could try if you really feel like your score has suffered since the beginning of the pandemic. I also, want to emphasize, your business is helping people improve their score. My business is helping improve, through various means. And mine is my one tool in my toolbox is helping people with accuracy on their credit report. When people call me and they go, I want to improve my score, I don't care about your score. I don't care about your score. I care about the accuracy of your report and whether or not your score reflects the actual accurate information in your credit report. So, you might call me and you're upset because you have a 650, but the last guy I talked to is thrilled that he's built his credit up to a 650. So scores are really arbitrary. And when you call me to talk about credit reports and credit scores, I usually say, I don't really care about your score. Let's just get your reports. And I do offer a no charge credit report review. So I see a lot of credit reports. Matt, you probably see more scores, or Matt, your success is probably measured more in the score, where I just
I
do
have
what
the
I
same
can.
philosophy. We don't like to focus on the score because the score is what the score is. Obviously, everybody wants a higher score, and our job is to try and see, are there any inaccuracies or things that we can attack on the credit report that would give you a better score. That's not our objective. Or, alternately, it is, we'd like to see consumers with a higher score, but we're trying to see if we can get some of that negative information removed or help people do better and perform better on the scores
Right.
with some different tools to get better scores, but it's not ultimately what it is. We're trying to make sure that report is accurate.
And we talked a minute ago about that upward trend. And one thing you said is the longer you have an account open, or the more, the longer your credit history, the better your score is. And I think too, there's just more credit education out there. I just think people are much more in tune to credit and credit scores, and I think they're paying more attention to it, and they're trying harder, and that's what's important. One thing I want to get to before, because this is the Monday Mortgage Minute, let's talk about the forbearance, what happened to mortgages and how they're reported since the pandemic. So tell me, what's this slide
Yeah,
about?
I popped a slide up here for you, just showing that, if you have an account in forbearance and it shows on the credit report that this account is in forbearance, it's not going to negatively affect the score. And so we've had a lot of those during the pandemic for student loans, for mortgages, for car loans. A lot of lenders are reporting accounts in forbearance, and so that's not a negative. And so consumers who might otherwise have been reported later, who struggle with their payments, aren't being reported late right now because of the pandemic. And that has certainly caused an increase in those scores. So again, if you have an account and you've contacted a lender and they give you a forbearance, that account is not, it's going to show in forbearance, and that's not going to be a negative on your credit report.
The other thing I've seen is during this period of time, I've seen no scoring, right? No anything, not even an okay, not a check that it's okay, not a 30, 60, 90-day late, certainly, but there's just nothing in those months, which again, I don't know if that hurts or helps. I think in the end, it's better than it showing late. And if lots and lots and lots of people have these blank periods, then we're all kind of scored against each other too. But the one thing I wanted to emphasize with that about, say, forbearance, for me, that's a word I hear mostly in the mortgage context. So if you have a home mortgage and you asked for a break during the pandemic, you can get, in some cases, up to 18 months of forbearance or longer if you request extra, or if your hardship hasn't ended yet due to COVID. But now what we're seeing is a lot of people are trying to come out of their forbearance. They're back to work, they've saved money, they could pay their monthly mortgage again and they want to, and they're struggling coming out of that forbearance. So I think a tricky part that we're going to see in the next 3 to 6 months is people calling me and saying, I'm back on track with my mortgage finally, but they reported me like 4 months late while we were working it out. And so I want people to first work on getting back on track with your mortgage. Don't sweat what's going on with your credit report while you're working on getting into the program or repaying or whatever you need to do to get back on track with your mortgage. Let's look at it once you're back on track, when you've paid 1 or 2 months regular again on your mortgage. Let's look at your credit then, and let's see if they messed up, if they shouldn't have been reporting it negatively, if they did, while you were working out the forbearance or at the tail end until you were transitioned back into your monthly payments again. So I just wanted Matt to emphasize and to repeat, you should not be reported negatively if you were in forbearance. You also put up a slide the other day, and I posted a comment where there's a group of people in the middle range of scores, right? So to describe what this slide is.
So here we have just a snapshot of people's scores in July of 2019, 2020, and 2021. And you can see that those are represented by different colored bars. And at the very top, you can just see it'll summarize the average US score. You can see it going from 706 to 711 to the present 716. But you can see in this slide, in the very low end, you'll see the dark blue is the older 2019, and going to the right is more recent bars, July 2020, then July 2021. And you can see fewer and fewer people are in those low buckets of low credit scores. And there's more people in these higher buckets of higher credit scores. People in the middle have tended to stay in the middle there, in the 600 to 649 range, and roughly the 650 to 699. People in the middle are in the middle, but the low end people and the high end people are doing better. a lot of people with those low end scores are improving and getting higher scores.
And I think that's really interesting and exciting because it can be really discouraging to be under 500 or under 550 or under 600. A lot of people come to me and they're just like, I give up. I just can't, I'm trying hard. I can't do it. And so it must be really encouraging if you were to have checked your score a year and a half ago and you check it now and you do see an improvement. I think that says something. Plus, some of the reasons is we have more cash, right? People are either spending less on commuting, so they have more. Then there was all that stimulus money and the unemployment, the extra unemployment, and all these things that I think the trends show that people were paying down balances and using their credit less, which is going to result in better scoring, higher scoring. I think too that recently, so that's I lost my train of thought there, but that was really interesting, and I'm really happy for people who are building. I think it's interesting that the middle group, the 600 to 700, basically didn't change, and I feel bad because they're the people that if you're closer to 600, you don't really qualify for good mortgage rates. If you're closer to 700, you do. So I'd like to think that maybe there was some movement within that range, or would that show somewhere, Matt? Right? Like if you went from 600 to 650. Would you be in a bar that went up, or 600 to 640?
If you were in that 600 to 650, you pretty much stayed the same. In general, like a lot of people, some people in that class went higher, some went lower, but you were the same. I want to focus on one of the things you said there about the utilization. I have a slide that addresses that particularly. And here you can see the average. I'm going to focus on this line over here, the average credit card utilization. In the beginning of the pandemic, utilization went down 8%. And as the pandemic continued, it still continued to go down. The average card balances down initially 10%. And in the past year, again, another 4% decrease in the average card balances. You'll see this also demonstrates those negatives we were talking about. If you had a 30-day past due, fewer and fewer people have those 30 days in the past year. This one is for people who have a 90-day or more past due in the last 6 months. And again, you can see numbers just plummeting on people who've had those kind of delinquencies. And so you can see the delinquencies are down, utilization is down. And to your point, I think that's exactly what's happened. I think we have a lot more money in the economy, a lot of stimulus checks, a lot of business PPP loans, a lot of unemployment benefits for people. And that money has gone to help a lot of people who are in those lower score brackets, and they're doing better.
It's encouraging to see that they're actually, when they do have extra money, they're using it to better their household finances. They aren't buying junk. They're not blowing it on stupid things. They're saying, this is important to me. It bothers me that I had a $3,000 credit card balance that I just can't seem to kick. I'm going to try to chip away at it.
People were also going out less,
going out
out
less,
to the movies less, to the ball game, the concerts. Right. You got a little extra cash flow, and they were using that on their credit cards.
After working from home for a few months, my husband is now actually bringing his lunch to work a few days a week, which he never would do. So it's easier. He's like, oh, I like this lunch I've been eating. I don't want to have to eat out like I do every day at work. So, I think habits are changing as well, which can reflect in finances. So,
I want to hit you with another score towards that. This one is from July 2020 to July 2021. And here you can see very quickly in the very middle, you see a zero, that 5% of consumers didn't change. 5% of the consumers from July 2020 to July 2021 have the same score. But other than those 5%, 95% of us had a score change, right? It went up or it went down.
Yeah.
And if you look at the top right, 56% of people had a score increase versus only 39% had their score decrease. And you can see those numbers, they're increasing at a greater rate. It looks like if you look at this graph, about 15% of people had a 1 to 9 point increase, versus people who lost 1 to 9 points is only 12%. So you can see not only more people going up, but it's going up more. Right. And that's obviously what led to the increase in the average score.
Yeah, some people went up 50 points. That's fantastic. And if you can maintain that, then they're only going to come out of this in better shape. And when has the middle class come out of a crisis, a financial crisis, in better shape, right? We were talking earlier, 08 and 09, the difference between this crisis and 2008, 2009, when the credit bubble burst and the real estate market burst, and the middle class were seen as the cause of that, right? At that point, the attitude towards a middle class person who was struggling to pay their mortgage or struggling to pay their credit card debts was, well, you shouldn't have borrowed that much money to buy that big house. You didn't have that kind of money, obviously, if you can't pay your mortgage now. Never mind that, all the values went down and people lost jobs. So, which was not an individual homeowner's fault. But now there's nobody untouched by the pandemic. And I think immediately when the government started shutting everybody down, and people, they knew, well, everyone's going to be on. We cannot allow banks to continue to foreclose when people are clearly out of work. We're trying to figure this thing out. We can't just allow the banks to just now take over. First of all, courts weren't even open, so it wasn't going to happen. We have to do something. We have to institute mortgage foreclosure moratoria. We have to give the creditors some kind of justification to go gently on their borrowers, right? So that their own creditors wouldn't come after them. And I think that's there's no one person who's like, well, I wasn't affected by the pandemic. What are you guys all talking about, right? Like every single person,
everybody,
every single person, working class, middle class, upper class, everybody. So that's what the difference was. And I think I don't want to get too political, but I think that the middle class and working class are typically not trusted with what's considered public welfare. But what did we do with it? We paid down bills, right? We acted responsibly. We did not blow it on stupid things. We put it back into the economy. We bettered ourselves. And isn't that what everybody wants? And we all do well when we're all doing well. And so I think that it's just an interesting difference between 2008, 2009, and 2020 and 21. That we are finally feeling like we are all in this together, and it's not the middle class's fault when they fall in hard times. So.
Yep. One interesting thing too is that a lot of people have referred to this as a bubble because there's a lot of people who are in a forbearance with their mortgage, with their car loan, with their student loan, and what's going to happen when that ends? Are they going to be able to resume those payments again? Are those payments going to be deferred, or are they going to have to come up with all that money? Do they have it? So a lot of people are wary of this arbitrary increase in the scores because a lot of people, to your point, they were saying they're just not getting reported at all, not good, bad, or anything. It's just there's nothing reported. And then the question becomes, what's going to happen? Are we just forestalling this? Is there more bad coming? And it's just not here yet because of all the forbearance. That remains to be seen.
I don't know that there's going to be like a crash the way there was in 08 and 09. The problem then was so many people lost jobs that they couldn't pay back the bills, and they couldn't pay back the money they had borrowed when they had those good jobs. I don't think anybody was able to get extra credit, borrow more money because they had the stimulus money coming in, right? No lender was like, oh, you're getting $300 a week for the next 4 months. Great, we'll lend you a 10-year loan. They weren't doing that. So I think there's been much more responsible lending as well. And hopefully most of the people I've spoken to have been able to save money. Because they're either not paying their mortgage, they're not paying credit cards, they're not paying student loans, and they have some savings then, despite never having been able to do that before. And so there will hopefully be a 3-4 months at least. They'll be able to bridge the gap, right? If they aren't fully back full time yet, but they have to pay their car loan or their student loan again, hopefully that savings will get them through until maybe the economy improves and they're back to their prior level of income, that they'll have enough to pay those bills again. But I think it can't hurt. The message is it can't hurt to continue to ask for help. If you can document it, very likely your creditors will work with you. I reach out to me because I've been working with people who are coming out of mortgage forbearances and back on track, and I've seen a lot of problems. I think the services are overwhelmed. I think they're not trying to pick on you. They're not trying to single you out. They're not trying to deliberately deceive you or treat you badly. I just think they're very overwhelmed processing the way they were at the beginning, where they're putting everybody in forbearances. Now they're taking everybody out and they're trying to process all the documentation properly. And so some people are being, falling through the cracks, but I can help with that.
I think a lot of that too is also changes in the workforce. They were affected by COVID just like we were. And so they've lost employees and they have new employees who don't really know the system well yet.
Right.
So,
and then like let's say let's say Bank of America is servicing a mortgage. Well, Bank of America services FHA mortgages, Fannie Mae, Freddie Mac, conventional, USDA. So every single one of those programs has different parameters and they're just trying to keep their head around it. So they might not realize that you have an FHA loan and they're treating you like a Freddie Mac borrower. and all we need to do is set them straight, and it's not that hard. So let's, don't let yourself get into foreclosure, reach out for help. Don't let your credit card bills go behind, reach out for help. And I think the best thing is don't sweat what's going on with your credit report as a priority. Get everything back on track, and then let's take a look at your credit after the fact and see if there's a way we can ask for correction, because I think it's too hard to make decisions based on what it will do to your credit score. I think you just need to make the right decisions for you and your financial situation, and then worry later about whether your credit reporting was accurate. Oh, good. I'm glad you believe that, because
oh yeah, absolutely. Listen, the first thing is take care of yourself. Credit's important, but it's going to come secondary. Take care of yourself, take care of your house, take care of your bills, and we'll worry about what's on the credit report later on. If they did something wrong, they didn't report it right, we can worry about that secondarily, but first just make sure everything gets on track.
Great. I really want to thank you again, Matt Listro from National Credit Fixers, for being here on the Monday Mortgage Minute. I really appreciate it. And he runs the Facebook page, CreditCon. So if anybody's really interested in this stuff, you can ask to join that page. Maybe you can go to the convention. And call me if you want Matt back, and we'll talk about anything you're interested in. All right. Thanks again, Matt.
Rob. Thank you very much.
Talk to you later. Okay. Bye.